Hey, all you beautiful people. Micah Roquiero here, Mr. Utah Real Estate. Got another one for you today. Today I've got a good friend here, Matt.Smith with Neo Home Loans. We're going to talk about lending and options and what's going on with rates and all that right now.
Kind of going to cover it all a little bit today, right?
Yeah, so I've got, we all know how the rates have gone up over the last year or so, and buyers are a little bit hesitant to get out there and look at homes and buy them. They're waiting for those rates to come down, but we'll talk about the rates here in a minute. But one of the big questions I always get with some of my buyers is credit and credit checks. And if I go apply for a loan, it's going to hurt my credit. I know it's a little bit different with mortgage versus like going out to RC and get some furniture or getting a car loan. But with the credit checks with the mortgage, how does that work?
Yeah, so you kind of hit it on the head there, and there's a lot of misunderstanding out there, and I just hope I can clear things up a little bit for folks, is that a mortgage inquiry or credit inquiry from a mortgage lender is different. It's a different algorithm, different scoring model that's run versus, say, like the credit score you get on your credit card or at a consumer level, right, for a credit card or an auto loan or something like that, right? If you're in at a a department store and they offer you a credit card, they're going to check your score, and it's on a different scoring model that's used for that. So those can be a little bit misleading. People will call me often and say, "Hey, I know my credit score," and oh, great. Well, what's the source? I ask them. I say, "Well, my credit card gives it to me." Okay, and then I have to kind of explain the differences between the consumer credit model and a mortgage model because they are very different. And typically the mortgage model is a little bit lower in score than, say, the consumer model because of just the range of scores that are available there. So it's just a completely different scoring model. So it's a little bit different for a mortgage, but a lot of folks are a little bit concerned at first, like, I don't want my credit run. I've got great credit. I don't want you to run it. But that's the thing we need, right? So I guess kind of another way to an example, if you will, in a different industry is like in medicine, right? Like if you have an issue with your knee and you go into your orthopedist and say, "Hey, I need knee surgery," and don't allow them to do an x-ray or an MRI or any kind of scan or lab work or anything, right, to diagnose how to treat your knee, right, or whatever is ailing you. That'd be kind of the same in our world of like, I don't want you to pull my credit, but I want you to tell me what you can do for me, right? And so really for us, that's kind of like our best way to diagnose your scenario and how we can best help you. And oftentimes too, where clients will have something erroneously reporting on their credit that's negative, right, negatively impacting their score. And if we pull that credit early on in the process, we can help them game plan to overcome anything that's on that report or help correct anything or improve their score as much as possible between at the point they first call us and apply and when they actually buy a home. So a lot of misunderstanding about credit and a lot of hesitation with credit, but why work towards having a really good credit score and then not using that credit score when you need it to be a benefit the most, right? And it really just helps me guide somebody on the path. Like I don't sell anything, right? I'm educating and I'm guiding, and just like you on the real estate side, we're educating them and empowering them to make the decision that's best for them and their family. And so there's a lot of hesitation in our industry about getting your credit pulled. But what we do at Neo that's a little bit different than most lenders, I would say, is that we do a soft credit pull up front. It doesn't give me everything, right? But it gives me a really good idea. I get 2 of the 3 scores, and in mortgage, we use the middle score of the 3. So we'll pull from the 3 major bureaus, and whatever the middle score is, that's one we'll use. So worst case scenario, we know what your lowest possible middle score is, because we don't know what that third one is, whether it's the highest or actually the middle or the lowest, but it gives us a good idea of where you're at credit score-wise, and then also helps us know what's reporting, if anything erroneously is reporting or anything negative that you're not aware of, right, is reporting, and then it helps us give you guidance right out of the gate, accurate information as opposed to working hypothetically and potentially misleading you. Now, the beauty of the soft credit pull is that it doesn't negatively impact you on your credit profile like a lot of folks are afraid of. Like, I'm going to get my credit pulled. It's going to ding me 10 points. I work really, really hard to get, 780 credit, and it's going to damage my credit. So at first, right out of the gate, we'll do the soft credit check, put together some options for you and help educate you. And then when you're ready to take that step and get a formal pre-approval done, then at that time we would pull the full credit report.
I was going to ask you about that too, is because I've got some clients that, they say, I'm not quite ready yet, give me a little bit. But I always suggest to them, at least get your numbers looked at. Let's see what it's at, just in case. So we know going forward what you exactly need to do. And the question they always is, well, I don't want it to hurt my credit. I don't want to ding my credit. I'm not ready yet. And from what you're saying, it doesn't really hurt that credit.
No, yeah. I mean, and even if you did the full report poll, right, the full credit profile, it's going to be a very minimal impact to your overall score, right? I mean, your scoring model, depending on the bureau, is a little bit different, but it's well over 800, right? Well, I mean, if you had, let's just say, for instance, $850 in cash, right, and I needed to borrow 10, you're probably okay with that, right? It's not an astronomical number as opposed to how much total dollars you have. So, yeah, that first poll may, affect you negatively a few points. Everybody's algorithm is different because everyone's credit profile is a little bit different, right? So the way it's going to impact one person versus the other is a little bit different. But yeah, there will probably be a few points there, but credit inquiries don't stay on there forever, right? They're going to eventually drop off, and then that goes out of the algorithm and you gain those points back. So, but to really know what we can do for you from a mortgage standpoint, what your options really are, and help you best game plan and remove any doubt, of your ability to get a mortgage, that's like key. That's like the first step we need, is that application and credit report. So,
and how much does this cost someone to come in and have them check you out?
Very expensive. It's free $99. So there's like no cost, right? Initial consultations, just to meet with me for 30 minutes to an hour, go over your hopes and your dreams, is what we call it, your hopes and dreams call. So I can get a big picture understanding of what, what you're looking for. And not only just as far as like buying the home, but like all the way across the board financially, right? Like we'll dive into, assets and liabilities as well. Like I want to take a big picture look at your profile and how I can help educate you and give you some recommendations, some different options, and really maybe even at times, and this may come out a little wrong, challenge your thought, right? Is that a lot of clients come in and know exactly what they want, or they think they know exactly what they want. But I like to give them a couple of different options they haven't even thought of, that they may go, wow, like that makes more sense to, say, put a little bit less down into my home, and then because of the high, consumer debt I have, put more money on that. That drives down the, household budget, if you will, like the household debt ratio, right? So eliminate some of the other debt, put a little bit less into my home, right? I'm going to finance a little bit more, so my mortgage payment is a little bit higher, but we get more bang for our buck, so to speak, by putting a little bit less down and removing that consumer debt, because those payments on the consumer debt are going to be higher, and especially most of them are higher interest rate, whereas the average credit card right now is over 20%. Auto loans are in the teens, right? So if you've got this given time, somewhere ballpark around a 7% mortgage rate, it would probably make more sense to eliminate that consumer debt, shrink that monthly outgoing expense there, and then by putting a little bit less down, it doesn't move the needle a ton on the mortgage payment. People are really surprised when they see, oh wow, I could really shrink my budget overall by eliminating some other debts. So that's something that we'll take a look at, and like I say, just challenge their thought process a little bit and give them something else to think about.
So like you said, that is free 99, FREE, free 99. Get in there, have your numbers looked at, have Matt get you on a game plan at the very least. I mean, if you think you're not quite ready, you've got other bills you got to take care of or whatever, at the very least, he'll put you on a game plan and get you on a path to go where you need to go. At the very least, you're building your credit, you're fixing your credit.
That's right.
And it's free.
Yeah, cleaning it up and then just creating that game plan. And then I'm there every step of the way along with you, shoulder to shoulder, right? And just helping clients execute on that game plan that we create initially.
So another question I get from some of my buyers is, I don't have enough down payment money. There's the old thing out there that you got to have 20% down. I hear that often, 20% down, which is not true. But I hear it all the time. I don't have enough money to put down. How much do I need to save before I can, buy a home? So what are the different options and loan types that the buyer can go through that?
Yeah, great question. So I'm surprised at this day and age, in 2023, how many people still think you have to have 20% down to buy a home, which is just not true. There's several 0% down options, like VA, for example. If you have that benefit, right? If you're a veteran and you have the VA benefit, that's, I think, personally one of the best loans out there. and rightfully so, you've earned that. You should take advantage of that with the zero down. There's also in rural areas, you can qualify for a USDA loan, which is 0% down. Other options too are going to be your more traditional FHA, which would require a minimum of 3.5% down. Conventional for a first-time home buyer is 3% down, but there are also down payment assistance programs and grants that can help cover your down payment plus some of your closing costs, if not all of them, so you could potentially get into a home even with an FHA or conventional loan with nothing out of pocket. When I bought my first home almost 20 years ago, I used a zero down loan, but it was an FHA-based loan, so I had a 3.5% down requirement, but the loan program I used was a down payment assistance, so I got a small second mortgage that covered my down payment plus some of my closing costs, and then I negotiated in the terms of my offer with the seller to cover the rest of the closing costs. So I literally walked into the title company to sign closing paperwork with a pen. And that was it, right? So it was, there's so many different programs out there. Now, obviously, everybody's case is a little bit different, and sometimes it makes sense to put a little more or even a little bit less down. But for the minimal down loans, you've got several zero down options, down payment assistant grant program options, and then even just a traditional FHA 3.5% or conventional would be 3% for first-time home buyers.
Yeah, and I've heard there's a couple of grant programs that have come out recently. I think there's the new build one. You have to be in a certain, it's like, I think 20,000. Is that correct?
Yeah, there's a 20,000 new construction first-time home buyer program. There's different counties have different, like Davis County here in Utah. I believe it's $50,000 grant or up to a $50,000.
Yeah, we just heard about that one a couple of days ago. Yep. Davis County has a $50,000 grant program.
And a lot of folks too, they want to get into a multi-unit property, like the first-time home buyers, and they're like, I can afford the mortgage maybe, but like I'm not comfortable with that mortgage, especially with where interest rates are at right now. And so you could go even a multi-unit, meaning 2, 3, or 4-plex, right? With an FHA loan with 3.5% down. It's challenging right now with FHA with a 3 or 4-plex because by their guidelines, the rents, the estimated rents for the property, right, for all 3 or 4 units on a 3 or 4-plex, whatever that anticipated rent is, has to cover the mortgage payment. With where rates are at, it's really hard to do. So there's a new conventional option. If you're going to live in the home, a primary residence on a multi-unit, a 2, 3, or 4, you can put as little as 5% down starting mid-November. I believe it's November 19th is the date that'll go into effect, where before now, or I guess as of right now, right, is 15% down if you're going to live in the home and buy a multi-unit. And the beauty of this program is that on a 3 or a 4-plex, like there's not that, guideline or challenge with making sure all the units can collect enough rent to cover the mortgage, right? Liquidity test, you wouldn't have to do that on a conventional type loan. So as long as your income and the expected rents for the other units you're not going to occupy can cover, the housing expense plus whatever else you have on credit, right? As long as your debt to income ratios are in line, you're golden. You could get into a 4-plex with as little as 5% down.
A lot of options for you out there. So, so many different things that come talk to this guy because he'll give you all the options on that. And then the last topic I want to cover real quick. Well, not real quick because this might be a little bit more, but the last topic in question I always get is rates are so high right now. I'm just going to wait till rates come down. I can't afford with these 7. They're up in the 7s right now. I just can't afford it. There are different options to bring down the rate as well. Yeah. As low as down into the 4s, I believe, right now. That's right. So what kind of options do we have as far as trying to get that rate down? Yeah, so affordability is the hot topic in our industry right now, right, in the housing market. It's the biggest challenge we all face, how to combat affordability. And I think a lot of people, the first thing that comes to their mind is the way I can drive my cash to close down, my closing costs, right, my payment, is to get a price reduction. And you and I know that that's not always the best strategy. Personally, right now in this higher interest rate market, I think you are so much better off rather than asking the seller to reduce the price, keep the price where it's at, or maybe ask for a little bit less of a price reduction, but ask for credits. So seller concessions or seller credits. So the seller, depending on the loan program that you're getting, they can contribute, 3% on like a conventional loan with 5% down, right? If you put 10%, you can go to up to 6% of the purchase price. So for example, on a $500,000 purchase price, if you got a 3% credit, that'd be $15,000 that the seller's going to essentially give you at closing to cover your closing costs. Now that can combat affordability from a cash to close perspective.
But if I've got enough cash and the biggest pain point is the payment, what else can I do to help combat affordability? Well, we can take a look at a couple of different buy down options. So there's a permanent interest rate buy down, so meaning for the life of the loan, for the full 30-year term, right? That interest rate is bought down permanently lower with the seller's dollars. Now, it doesn't move a ton lower with the seller's dollars, but what would move it even lower would be a temporary interest rate buy down. So you could do this on a conventional loan or an FHA loan, right? And several other loan programs as well. But speaking to just traditional loan types, you could do a 2-1 buy down temporarily, right? So for the first year, your interest rate's 2% lower. For year 2, it's 1% lower. So for example, let's say your interest rate, just for, easy purpose rate, 7.5%, right? So you're going to lock in 7.5% on a 30-year loan. Well, on a 2-1 buy down, you're going to get the seller's credit at closing, right? And the dollars are going to get held into a reserve account. And then each month moving forward for the first 2 years, a portion comes out to help subsidize your interest. And that's what it is. It's an interest subsidy that's paid for by the seller for the first, 2 years. And so in year 1, remember your interest rate 7.5%, and it still is, but they're going to pay the difference between 5.5 and 7.5. So each month a portion is going to come out to cover the difference in interest. Then after the first year, your rate that you're going to be paying on is going to be 6.5, right? But your actual rate is 7.5 still, right? But the seller is going to subsidize that 1% difference in interest for the year 2. And then after year 2, it would adjust up what you're paying to the 7.5 for the remaining 28 years of the loan. Now, the beauty of the temporary buy down, a couple of different things, is that it's temporary and it's going to really drive that rate down significantly lower than it would be on a permanent interest rate buy down. But the cost of that buy down, it can only be paid for by the seller on the temporary buy down. That money gets held in the reserve account, kind of like for your taxes and your insurance, the escrow account, right? Well, let's say in 6 months after you close, rates drop, rates are in the 5s, and it's time to refinance, right? Okay, well, we're going to go ahead and do the refinance, but whatever's left in that reserve account is going to go right onto your principal balance, pay the balance down lower. So when we go to refinance, you get essentially a price reduction at that time. If you do anything with your loan, if you refinance or even sell the property, whatever's left of the seller's dollars goes right onto your principal balance, pays that down lower. So I get a interest subsidy for the first up to 2 years on the 2-1 buy down. And then also if I refinance or sell in the first 2 years, then I also get those dollars applied to my principal balance, which is going to help reduce the principal balance when I go to refi on the new loan. But not only is there a 2-1 buy down, there's a 3-2-1 buy down. This is what you kind of mentioned earlier, getting rates down into the 4s. So again, same example. If you're on a conventional or FHA loan and your rate is 7.5, you get enough funds from the seller to do a 3-2-1 buy down. So for year 1, you're going to be paying based on 4.5. Year 2 would be 5.5, and then year 3 would be 6.5, and then after year 3 it would adjust up to the 7.5.
Perfect. Yeah, and you mentioned the seller pays for this, right? So I know a lot of your buyers like, why would a seller pay for that? He just sell his home. Why would I want? How am I going to get a seller to pay for this?
Right.
Well, with today's market, homes are sitting on the market longer. There's not as many buyers out there, so sellers are more willing to contribute to get that home sold. Usually we would go in there in the past, we'd go in there and we'd do a price reduction. Hey, let's lower it down 20,000, see if the seller will take it or whatever.
Yeah.
In the past, that's what was traditionally how we did things. But now we say, instead of lowering the price, the seller, please buy down my rate. And it's a very good possibility. The seller's going to say, yes, I need to sell my home. What can I do to help you?
A lot of sellers are also buyers. And so they may be relocating for a new job somewhere, and they got a deadline, right? Like, I got to sell my home by this date in order to move my family to the new, city or state or wherever they're going, right? To start that new job, to where they're a little bit more motivated. And if their property's sitting, we're seeing a lot of listings, right? Advertise that the seller is willing to credit 3% of the purchase price towards a interest rate buy down, whether that's permanent or the temporary. So yeah, we're seeing it just advertised on the listings, right? And here's why. And I mean, I'm even seeing listing agents where they're charting like, here's what a price reduction would look like, but here's how much more affordable I can make it for you, and or your buyer if you're the buyer's agent, right? If they do the credit instead of a price reduction, and they do a temporary interest rate buy down, here's how much more affordable the home can be for them.
Yeah, so if over the lifetime of the loan, a price reduction, you don't get as much bang for the buck as if you bring that rate down.
That's right.
And you get more bang for your buck. And
yeah, your seller credits can impact affordability 400 to 500% greater than a price reduction would with those same dollars. So the seller, if you're going to ask me for a $15,000 price reduction or $15,000 credit, to me as a seller, it's all the same, right? I'm going to net the same on the sell as if I gave you a price reduction or a credit. So
yeah, and buyers are always saying, I'm just going to wait till the prices of homes come down. How long have you been in the business?
18 years.
18 years. Over the 18 years, has it pretty much always goes up, right? I mean, you see your little ups and downs.
You'll see a little bit, but I mean, over the last 81 years, since they really started charting this, homes have appreciated 73 out of the 81 years. They've had 7 down years in the last 81 years. So 73 up years, 7 down years, and 1 tie, meaning that homes didn't appreciate that year. So to kind of put that in context for some individuals here, it might make more sense this way. So in the NBA, they play 82 games, right, a year. The best record in the NBA is 73 wins and 9 losses, right? Well, in 81 years, real estate's already got a better winning percentage than any NBA team in history, right? Any WNBA team in history, right? So real estate, betting on real estate is a good bet because of the long term. In most cases, it's not a short term, get rich quick, right? It's buy and hold. So, if you're going to be somewhere for a year, it might not make the most sense to buy, but if you're going to be there 2, 3, 4, 5, 6, 7 years, it makes sense to buy real estate because of the appreciation and the amortization of your loan, right? Paying down that loan balance while my home value is going up, my balance is going down, creating net worth there that now I can leverage that in the future to buy other real estate or other investments. Right?
Yeah. So if you're waiting for those home prices to drop, I don't know, nobody's got the crystal ball.
Right.
It's, like Matt said, over the long term, it's the best investment. Yeah. Very,
very consistent, right? And I think just a lot of folks that are a little hesitant to get in, think about, the 7% interest rates right now, right? And that I'm a 30-year loan, I'm going to be locked into this forever. Well, no, you're not, right? If you're partnering with a good lender, they're going to help you monitor and manage your mortgage. And that's what we do. We've built an AI system at NEO that monitors our past clients' mortgages 24 hours a day, 7 days a week, and bells and whistles start going off as the market adjusts, right? So as interest rates come down, we're sending out notifications to our clients. We're calling them, we're texting them, we're emailing them, right? Letting them know, hey, you need to pause. Let's take a look at the numbers and see if a refinance makes sense.
Yeah. So buyers, again, saying, let's wait till rates come down, and then prices come down. Wait till prices come down, then I'll be in a better position. But or rates. But you remember what it was like 2020, 2021, right? Rates were 2s, 3s, 4s. Yep. My goodness.
Historic lows, right?
We've never seen anything like that. And unfortunately, that was kind of the taste everybody got, and they think that's the normal now. It wasn't the normal. That was just a fluke kind of thing that happened. And we're kind of actually in the more normal range right now. Historically, we're in that 70. But if you do wait for rates to come down, it's kind of what happened last time that happened, right?
Yeah. So when
buyers came out and you were doing multiple offers, and you don't want to get into that situation again.
Yeah. So right now we're still at limited inventory, and there's still a decent amount of demand out there that people that can afford to buy now or are not afraid of the higher rates because they understand that, hey, in the future I'm just going to refinance it. So there's we're still seeing multiple offer situation, but not as much as we were seeing back in 20 and 2021. It was all out bidding wars, right? Yeah. And so right now with the higher interest rates, it creates opportunity for buyers, right? So for, example, back in 20 and 21, 0 down buyers were getting pushed out of the market because home values and prices were going up so fast that appraisals couldn't keep up. So I guess let me kind of explain that there was so much demand because it was so cheap to buy a house because interest rates were so low that there was just an insane amount of demand. Well, supply was getting gobbled up. We didn't have a lot of supply, so it was all out bidding wars. People were paying more than the home the seller was asking or the home was worth. And so to a seller, if I've got 10 offers, somebody comes in with a 0 down loan, that tells me they probably don't have a lot of money. So if the appraised value doesn't meet their offer, the sales price, then they're not going to have enough money if they don't have money for a down payment, they're not going to have money to bridge the gap between, the value of the home and what they offered to buy it out, right? Well, there were so many buyers that are like, yeah, I'm putting 10% down or 20% down or whatever, and I've got cash in the bank. People were just paying cash over appraised value. And so, again, it was kind of pushing out those zero down buyers or, lower down buyers because they didn't have a lot of money to bridge that gap between a low appraisal and the sales price. So right now, with the higher interest rate and a little bit less demand, it's a great time for zero down buyers, right? Because they can come in and negotiate with a seller and get their offer approved, lock into today's price, as opposed to waiting until interest rates drop and then there's a feeding frenzy in the market.
And prices go up.
And prices are going to go up, right? So if we wait for interest rates to come down, prices are going to go up. Because of the demand, it's going to spike. It's estimated that for every 1% lower interest rates, mortgage interest rates go, that opens up 5 million households that can buy.
It's a lot of people to compete against.
People to compete against, and we don't have the inventory for it.
And not only are you competing against other buyers, sellers aren't as willing to help you out with closing costs or buy down a rate. So right now I know it sounds weird, the rates are high, but it is actually a great time for the zero down buyers, non-cash buyers. And then when I was helping clients back in 2021, we were getting pushed out by the cash buyers. Cash buyers came in and just took everything. And I was getting frustrated myself trying to help these buyers that just didn't have the cash to do that. So if you're in that situation now is the perfect time to get the home.
Be really creative with offers, get in with zero down, and then have the seller help cover your closing costs and or an interest rate buy down to help subsidize your interest payment while we wait for the market to adjust. And that's kind of the target range is anywhere from 12 to 18 months. And again, no crystal ball, but that's the expectation for rates to start moving lower. It's the next 12 to 18 months. So great way to kind of wait that out in your new home. And then once rates do drop, at NEO, we know it's a two-part play when you buy now because you're in a higher interest rate that you're going to have a lot of opportunity in the near future to refi. We're going to waive our cost due free refi for you just to get you into a better loan situation at that time. And
the one thing I did when I bought my home was we were looking for a place that had the mother-in-law suite. And I know a lot of buyers are looking for that as well to help pay, you rent out the basement, someone helps you pay off that mortgage. And that's what we did. Me and my wife did that. We have our basement and we have a mother-in-law suite down there. And I know other buyers that are looking for that. And if you're a seller and you have one of those and you're ready to sell, those are hot. Let me know. We can get that one sold for you. Yeah, they are. It's house hacking, I think a lot of people call it, right? Is that you're going and buying a property and you're going to rent out part of that house to help you cover the mortgage payment. Yeah. So, or even if it doesn't, if it's able to put something in, you can put a kitchen downstairs or something. Yeah, unfinished basement, finish it out and build out a little mother-in-law apartment and rent it out. So I hope this answered a lot of questions for you all on these rates and credits and down payments and all that. But if you have more questions, you can contact myself or Matt. I'll leave our contact information down in the description. But thank you again for watching this. And if you have any questions, you can also leave them in the comments. Don't forget to subscribe, hit the like button, hit the thumbs up, leave us a comment. Yeah, please comment because helps us answer your questions next time around, right? Yeah, I know you guys have a lot of questions and it's a scary time and it shouldn't be a scary time, but that's what we're here for. We're going to guide you through the process. If you're ready to buy or thinking about buying, or I've got someone that says I want to buy but I'm going to wait till next year, at least come get your numbers run. Let's see which kind of game plan you should be on, what path we can put you on to bring your credit scores up, to bring your debt to income ratio down, to get the home that you want. Yeah, and that way you're not, out to sea without a paddle or a heading, right? That way you've got an understanding of where you're at and a heading, a direction of where you're going to go and how to get there, the steps to get there. That's going to remove any doubt and just put you in the best place possible when the time is right to buy. Yeah. So thank you guys. Happy selling, happy buying. We'll see you next time.